Hey, it's Chris with Life 180, and in this video, I want to talk to you about the perfect storm that's coming down the pipeline that's going to lead to massive inflation. Now, I don't want to just scare you, and I'm not just going to be giving this fear-mongering, conversation around hyperinflation or massive inflation, because I think what's happening is absolutely real. But more importantly than the fact that inflation is real, I want to walk you down a process so you understand why this is happening, and then ultimately, when you are more aware of why what's happening is happening, then you can make better consumer decisions around those facts, right? Like the bottom line is, if you look around, how is inflation created? Well, it's the concept of Keynesian economics. We have an elastic currency. If you're not familiar with that, Keynesian economic theory basically says in a distressed economic environment, the government has the ability, the Federal Reserve, which is not technically the government, has the ability to print money and sell notes to the government that they can buy, and they can put money into circulation. Well, here's the crazy part right now. Well, since September of 2019, the government has printed $9 trillion. Now, I understand it's COVID, I understand all that stuff, but here's the crazy part. If you look at the $9 trillion, that's 22% of all the money that's in circulation in the United States alone. Now, here's the crazy part about this. The government has printed this money, right? The Federal Reserve, I guess, has printed the money, and the government has put it into circulation with stimulus checks, with bailing businesses out, with giving all sorts of incentives to help keep people afloat. I'm not gonna argue whether that's right or wrong in this video. I just wanna talk math, and I wanna look at the things that are being kind of pulled over people's eyes. And one of the things I wanna bring to people's attention is this, usdebtclock.org, and this is amazing because it shows the national debt. Now, if you look here, the US national debt in the top left of the screen here, it says 28 trillion, 140 billion, 632 million, and it's going up really fast. Don't you wish you could make money that fast? This is how fast our government's debt is going out of control. Now, you can see tax revenues going up. You can see, go to usdebtclock.org and check it out. But here's the crazy part. At the beginning of COVID, our debt was just around $27 trillion. Our debt has only gone up $1 trillion, but we printed $9 trillion that has been pumped into circulation. And I don't understand how that hasn't led to more debt, right? So that is a liability that we absolutely have, and it isn't leading to our debt, and that money has gone into circulation. And so at some point in time, that money is not free. We're gonna have to pay for it as well. And we've been living in this environment where interest rates are suppressed, where there's a lot of pressure on all branches of government to support different people in different segments of the economy, small businesses, people who are in need, entrepreneurs, even big businesses that are making billions and billions and billions of dollars are getting bailed out with the idea of they're too big to fail. We have to look at how inflation is calculated. Now, I want to give a quick education. I'm not going to go too deep into all the nuances. You can certainly look it up. But ultimately, it's important to understand that the inflation is calculated based on the CPI, the Consumer Price Index. And basically, to keep it simple, the Consumer Price Index is based on a basket of goods. And the basket of goods is basically broken up into 3 categories. You have durable goods, which is basically like your automobiles, your appliances, stuff of that nature, the real durable goods. You have non-durable goods, which is basically like food and energy. And then you have services, and services can be healthcare, it can be your cell phone services, it's rent, it's stuff of that nature. And here's the deal, non-durable goods account for about 26.6 or so % of the economy. Durable goods count for about 10.9% of the economy, and services count for about 65% of the economy. Now, the Federal Reserve last year, during the economic crisis, even though the economy has bounced back, or at least the stock market has bounced back, the Federal Reserve right now is talking about the fact that they are comfortable with the fact that we don't have an inflation issue, because of the fact that the target inflation number that the Federal Reserve tries to manage is around 2%. But think about it this way. With everything that's been happening over the past year, what falls into the service goods category? Well, it's a lot of things that were impacted drastically. Now, service goods were actually up on the lower end of the spectrum at 1.4%. But the bottom line is some of the sectors of the service good industry, a lot of industries were hit really hard, and that number is I guess artificially low simply because of the fact that these industries like airlines were down 25%, were negative 25% on the CPI. Hotels and stuff of that nature, hotel rooms and lodging were down over 17%. Entrance into sporting events was down about 14% on the CPI, right? Because all these things got canceled, prices went down, people are making accommodations, companies are making accommodations for people to still use their stuff, right? So those are just a couple examples, right? But if you look at the non-durable goods, then you'll see that inflation is almost 4% right now, right? So what's gonna happen when the government has printed $9 trillion and you look at the fact that, everybody's lived it, right? A lot of people last year got stimulus money, and what happened with that money? A lot of people were home, they went out and they spent that money that they didn't earn, they didn't respect, they took it for granted, they didn't use it on paying down debt, they didn't use it responsibly. What do? They went out and bought flat screen TVs, they went out and bought cars, they put down payment on cars, they bought camper trailers, they did things to enjoy life so they wouldn't go insane in the process, right? What did that do? That drove the durable goods consumer price number even higher, which, at the end of the day, I guess that kind of goes against my argument, but at the same time, it comes into the fact that the government is printing that money. It's an artificial number, and that money is not accounted for. It's not accounted for in the debt. It's not accounted for in the velocity of money. So the money that's been printed and just given into circulation in the means of stimulus is not counted in the M4 money supply in as far as inflation goes right now. So when you think about that, really break that down, that's a really, really dangerous environment that we're entering. The bottom line is we have a massive inflation problem right now, and nobody even wants to say it, right? Like I just said, the Federal Reserve will tell you that they're at about 1.7 for consumer price index for the inflation rate for the year. The reality is, if you look at the things that matter most to you, if you look at the way that it actually impacts everyday Americans in the context of how is inflation impacting their paycheck, the money that they bring home, the money that they have to spend to live every single week. Food prices are up nearly 4%. Gas is up nearly 4%. All of these numbers are up almost 100% higher than the actual index that they're saying is not a problem. And the reason that that's happening is because of the fact that the services sector accounts for 2/3 of the CPI index, right? Of the CPI calculation. And the services sector is the one that got smashed the hardest in this whole environment because people were not going out to eat. So here's what's gonna happen. I've been saying this on videos for a long time. We have to take our medicine. We're gonna feel this one way or the other. You cannot avoid the pain when you hit a pandemic. It is absolutely asinine to think that we can go through a pandemic the way that we've gone through and that we're not gonna feel the pain, that somehow the government is gonna be able to just bail everybody out, print trillions of dollars, people are just gonna be good, we're gonna be able to keep buying cars, keep buying campers, keep going on vacations, keep buying flat screen TVs, deferring our mortgage payments, not having to pay our bills, and everybody's gonna be happy. The reality is the show is gonna come to an end, and I'm a big believer that the higher you go up the road, the further you kick the can up the hill, the bigger the cliff you have to fall off on the other side. And so here's what I wanna say. At the end of the day, we have a massive problem. And if you look around, you look at all the news stations, they're all saying the same thing. We have to deal with this. And so for you, I'm a big believer that there's always opportunity in every economic environment. So what is the most important thing that you can do right now? I think in times of stress like and don't take this as specific investment advice, right? Because I don't know you, I don't know your risk tolerance, I don't know your, what your circumstances are, but I can tell you my perspective here is that in this time we're not even gonna have inflation. What we're gonna have is stagflation. Stagflation is a definition that was brought in the 1970s, and stagflation is simply saying, you know what? The economy is going up, prices are going up, right? Because of the fact that the government has injected so much money into the economy. But the problem is that production has not kept up with the increase in prices. And that's exactly what we've had now. We've had money being printed, we've had people spending money, but we've had unemployment at all-time lows at periods of time during this crisis. Unemployment is still high, production is still way down, and yet we have these numbers of inflation that are getting out of control. So by definition, this isn't even inflation, it's way worse, it's stagflation. And so here's what you need to do about that. In times of stagflation, what you need to do is you need to buy hard assets. And this is where real estate is so, so powerful. You need to stop thinking about investing for accumulation by investing in a 401k or investing in mutual funds or even stocks, unless you're really, really good at picking stocks and managing it that way. I think you need to have a diversified area of assets. You know, I think hedging, maybe getting some crypto, getting some gold, getting some silver, something of that nature, I think is really good. But for us, I know for us, what we're doing is we're trying to get as much real estate as possible. If you can save up money, if you can put money inside of a contract, this is why I like whole life, and it's why I don't like index universal life, because I think with the pressures, the guarantees inside of whole life policies are going to be great, and they're going to be like banking alternatives. You're going to be liquid, you know, in that need, so you can borrow against it and you can access it, and you can, you know, purchase real estate properties. You can purchase gold or silver, whatever is right for you. But I believe hard assets are the thing that are going to protect you. The reason I love real estate so much is because even if you lose, if you buy the real estate property right, no matter what happens in the economy, you're going to be okay. Because if you buy it, let's say you buy a house for a couple $100,000 and it's renting for $1,500 a month. Well, what happens if that house goes down to $100,000? Well, as long as the rent is still $1,500 or goes up, it doesn't really matter what your net worth does, as long as your cash flow is good, right? Because don't forget, you don't live off your net worth. That is the whole myth and the lie about the accumulation model of investing, is people try to invest for 40 years during their during their career, and they try to get to retirement with some golden number in mind, not realizing that that golden number, what you need that number to be, changes based on the economic environment that we're living in. Saving $1 million when you're, you know, going through your working career, if the dividend rates were higher, if the fixed income markets could get you 8 to 10% per year like they could do in the 80s or early 90s, that was great. You know, but guess what? That's the model that was created to be. The 401k model, the IRA, even the Roth IRA, that whole model was designed and created when interest rates in the fixed markets were much better. The environment around us changed, and the philosophy and the strategy didn't change with it. What changed was they went from doing commission-based sales, front-loaded commissions, to doing fee-based sales, which actually robs you more, because if you do the math behind how much fees you're going to pay over a 40-year period inside of a managed money account, it's absolutely disgusting. And so what I will tell you is that you should, if I'm you, I would go out and right now with Section 7 or with 7702 that's coming out, the new regulation 7702, when it comes to life insurance, they're going to be reducing guarantees, and I think the stock market is going to have a lot of stresses on it. I don't think it's going to perform. I mean, historically speaking, the best way to make money is to buy low, sell high. If we're at an all-time high in the stock market and we've been going on a 12-year bull run, it tells me that that bull run is going to be coming to an end pretty soon. So investing in an IUL right now, when interest rates are all-time lows, the market's going to struggle. Insurance companies, I really strongly believe, are going to be reducing cap rates more and more and more. And so a cap rate that goes from 10 to 8 is going to have a seriously negative impact on the ability for an IUL to perform the way you need to see. That's why I love the guarantees inside of a whole life policy. And it really fulfills all the different needs that people have. That's why I'm so passionate about this right now. And the other thing is, depending on where you are in life right now, maybe you're closer to retirement. And I'm going to do some more videos on this. I don't do a lot of videos on this topic at all, but I think annuities are an amazing, amazing tool for retirement income distribution. One of the big things that you need to take into consideration when it comes to retirement, if you're 60 to 65 right now, I would be looking at annuities so strongly. Why? Because you have to consider not just rate of returns, but the order of returns. And that's something to consider as you get into retirement. Order of returns takes into account how much, what is the rate of return, not just what the rate of return is, but when that rate of return happens. So for instance, if you have $1 million in an account and you need to pull out, let's say, $60,000 a year out of that account to survive, you know, and then you got Social Security and all these other things on top of whatever you have for other accounts, that's fine. But if you need $60,000 out of that account, let's say year one, the market does really well. Let's say out of the first 10 years that you're in retirement, 8 of them are positive and only 2 of them are negative. Well, guess what? If in year one, let's say one of those years into the 10 is negative 20%, which is not outside of the realm of possibility right now, believe me. So what happens if that happens in year one? You're pulling 60,000 out and it goes down 20%. So now you only have $740,000. Now for you to pull that 60,000 out, you're pulling almost like 8.5% out of your account portfolio. That's kind of crazy if you think about it. Like, that's going to just destroy the value, and you're not going to give that account an opportunity to catch up. So what you can do with annuities is you can guarantee your income, and I think that's a big thing, because remember, we don't care about how much money you have as far as a lump sum. I'm assuming all you care about is making sure that you are able to maintain your standard of living for the rest of your life, right? Now, for me, I know that's what I'm always looking to help people do and coach people through, is saying, okay, when you want to make sure you're investing for cash flow. If you haven't done that and you've invested for accumulation and you get to this point in time, depending on where you are, you can pivot and try to turn that into cash flow. Or if it's too late in the game, you can either get an annuity and guarantee and lock in your income, or you can pivot some of that money, maybe turn qualified money self-directed. And I've got some contacts for self-directed IRAs that you can, and some suggestions that you could do for that. But you could take it and do that, and maybe roll and manage your own IRA, self-directed or solo 401k or something of that nature. And you could roll that in and get real estate with it. And you could actually manage the real estate cash flow that way. So not only will you have the real estate and the opportunity for the appreciation and all the tax benefits that come with real estate, but you get the cash flow that comes with it going into your qualified account as well. So that's something to consider. At the end of the day, I'm a big believer, because of the fact if we have inflation, I just happen to be in the camp that I don't believe we're going to have a financial crisis in the context of a dollar crisis. I know there are a lot of people out there that will say the dollar is going to hell in a handbasket, but I'm a believer that, listen, we live in a Keynesian economic world, meaning the rest of the world is suffering the same way that we are. We still have the world's reserve currency, meaning the rest of the world does international transactions in US dollars. So as long as we have that, the rest of the world is financing our challenges, and they have for the past 70, 80 years, since 1944 when the Bretton Woods Act was signed, right? So like, as long as we have this position as the world's reserve currency, we're gonna be fine, because as much as we struggle, the rest of the world is struggling the same way, and a currency is only worth value. We're not based on the gold standard anymore. Whether that's right or wrong, I think that's wrong, honestly. I think we should be held to some accountability like that, but that's just not the world we're living in. So I'm not gonna kick and scream and cry like a baby about this sort of thing. You gotta acknowledge what's what, right? And what's what is the fact that we live in a Keynesian economic world, and the United States is the world's reserve currency, and the value of a currency is only the value in comparison to other currencies. It's not the value in comparison to gold and silver and all these things. Now, all those commodities and all these things will inflate in value, and I think it's smart to have some of those things as hedges against the devaluation of these currencies. That's kind of smart. I think a small percentage of your net worth should be in those sorts of things. Think about real estate like this. If you had a stock that you could buy, let's say you bought a stock for, it's a really expensive stock, like a Berkshire Hathaway, and it's like $200,000 a share or something crazy like that, right? So you have the stock, but then that stock also pays a dividend, right? So if Berkshire Hathaway goes into a situation where the economy crashes and it goes from 200,000 to 100,000 and it loses 50% of its value, and it's paying us 5% dividend, right? Let's say that 5% dividend is still 5%. You go from having a $10,000 annual dividend on that stock plus whatever it appreciates to a $5,000 dividend, because 5% of 100,000 is only $5,000, right? But if you have real estate, and typically what happens when the economy struggles, what happens? Houses go into foreclosure. So when real estate historically crashes and comes back 30, 40, 50% as it did in 08, 09, what happens is the real estate rental market increases. Demand goes up. Why? Because people are losing their houses in foreclosure. So there's a flood of foreclosure properties. So there's opportunity with people with liquid cash. So that's another reason for whole life insurance, is to have that liquid cash ready to take advantage of that. If you have real estate ahead of time, people are always like, well, why wouldn't I wait for the crash? Because we can't time the crash. We don't know. I mean, the government has shown a pretty significant ability to manipulate and kick the can down the road, right? So we can't control that. And at the end of the day, it doesn't really matter. I think real estate will always come back. And I think that no matter what, it's not about the net worth or the liquid asset. If you buy it the right way and you're not over leveraged and you're not at risk of losing the house, it's all about buying it for cash flow. Because for real estate, the rental property, if you have a $200,000 house and the market comes down 50%, using the same example as the Berkshire Hathaway, let's say you're getting $1,500 a month out of that, that's $18,000 a year. Let's say you're just getting $1,000 a month. That's $12,000 a year for that property. And that's actually kind of low for a 200K property in the United States right now, depending on where you buy, right? So that's a 6%. If that property goes down to $100,000 because of the fact there's going to be a flood of renters, supply and demand with real estate is what it is, you're probably still going to be able to demand that $1,000 a month, that $12,000. So now, even though you lost, your net worth got cut in half, the dividend payment, the cash flow of that property actually went from 6% to 12% because you're still maintaining that $12,000 a year, right? That's the power of real estate. Plus the tax benefits and all the other things are amazing for what they are. So if I'm you, I'm taking a look at this, I'm taking it seriously. We have a perfect storm coming for inflation, stagflation, however you want to look at it. Do yourself a favor, get ahead of this thing, make sure you're guaranteeing your income if you need to with an annuity. Make sure you're putting yourself in a position that you are, getting yourself inside of vehicles, storage vehicles for your money that are guaranteed. That's why I'm so passionate about life insurance right now, whole life insurance specifically, and that's why I'm totally anti-index universal life right now. I know that they've looked great over the past decade. They still have not performed to the level that people have illustrated them at. However, I understand that a lot of people have not been hurt by them necessarily over the past decade. A lot of people are about to be hurt by them, I promise. If you understand how they function, this is one of the things that I just need everybody to understand. So I hope this helps. I hope you find value in it. If you found value in this, this is one of those videos that I think everybody needs to see and understand. So if you would share this, if you would just get it out there like this and share it, I would be honored, to help get this message out there on a bigger level. If you have found value in this video, and you haven't subscribed yet, please hit that subscribe button. Make sure you hit the bell. That way you get notified every single time that I launch a new video. If you are a subscriber and you haven't hit the bell yet, make sure you do that, because I am putting crazy content. I'm doing so much research and really keeping up to speed with this, because I'm taking this on as a responsibility to get this information out there into the world as much as possible right now. I hope this serves you. I hope you found value in it. And you know what, as always, until next time, and I mean this genuinely, I hope you have a blessed, inspirational day. Go out there, make an impact in the world, and I'll see you on the next video. Take care.